Good morning, and welcome to today's webcast, New Lease Accounting Standard, Impacts for Life Sciences and Tech. Before we get started, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning and welcome to our new Lease Accounting Standard webinar. My name is Findley Gillespie. I'm a partner in our advisory practice and I want to go ahead and introduce today's speakers. First speaker that we'll be joined by is Daniel Olson, who's a senior manager in our audit group. And as part of that, Daniel has spent his career both with us and a Big Four firm performing audit services over public and private companies. And as part of that, he joins us today to talk about what's going on with the new lease accounting standard, really with an eye towards technology companies, having spent a lot of time in that area. Also joined with me is Alex Osegueda, who's a manager in our group, and he specifically is in our technical accounting consulting group. And he has a lot of experience across a wide variety of industries, including both technology and life sciences and communications. And so he'll also be able to share some of the insights he's had in actually implementing this standard in an outsourced capacity for a lot of our clients. And then lastly, I'm Findley Gillespie. I'm a partner in our advisory practice. As I mentioned, one of the areas that I'm responsible for overseeing is our technical accounting consulting practice and working very closely with our SEC practice where I have experience working with across a lot of different industries, but primarily focused on technology and life sciences. So as we jump in today, let me talk just briefly about what our agenda looks like. We're going to start with really an overview of topic 842 and really give kind of an understanding of kind of what does the scope entail, what are the effective dates, when do you actually have to implement this, what's the transition guidance, as well as some of the key focus areas that have been really highlighted since this came out, even as an exposure draft through till now. Then secondly is we're going to dive a little bit deeper into really understanding the standard. And as part of that is what does the accounting look like under 842 and what and actually go through a couple examples to help understand that. Obviously, there's a lot of different variations in leases and lease agreements. We won't have a chance to go through all of those today, but what I will do is we will have an opportunity to look from both a lessee and lessor perspective and be able to highlight a couple of those things, including these examples. And then lastly, we'll close with what the actual impact looks like in terms of the financial statements, both in the face of the financials and the footnotes. So again, it's an opportunity to kind of go through this. I would encourage you to look at some of the other tools that we as a firm have available. We've issued some alerts recently. We've got a couple other publications related to the new lease accounting standard, some specific to technology, communications, and life sciences companies. So I'd encourage you to go to our website on that. Secondly, as I just want to say is I want to make sure that everybody gets CPE credit for this. And so as part of this is you do need to respond to those CPE polls. And as that relates to it, we'll just jump in with the first one right now and give you an opportunity to do this. So what you see right in front of you is just our polling questions. Again, the first polling question is what type of company do you work for? Is it public, private, governmental, et cetera? Please go ahead and select the answer that best represents who you work for. If you're consulting and across a couple different companies, we'll pick the one that you most closely identify with. And what we'll do for each of these is give you an opportunity to go ahead and select the best answer. Then we'll review those online. Again, for you to get CPE credit, if you're hearing this live versus recorded, you do need to respond to those polls. So again, we'll have 4 polling questions throughout the course of this presentation, and you do need to respond to 3 of those 4 to get CPE credit. So give everybody just a second longer here. All right, I'm going to close it here in just a second, so pick your best answer. All right, great. So it looks like we've got a mix of both public and private companies. You can see on the screen here in front of you, nearly 30% are public companies, and so I imagine that most of you are a little bit further along in the 842 process in terms of evaluating that. And then we see a lot of private companies. So 56% of you are private companies, and so obviously you'll get another year to do that. And what we'll do just here in a second is we'll actually jump into what some of that timing looks like depending on if you're a public company or private company. We'll try to distinguish that as we go throughout the course of this presentation. So overall, I want to welcome everybody here. We do know that certainly this is a hotter topic for the public companies, given that they have to comply with this very, very soon. And the private companies are probably still working on ASC 606, the new revenue standard. So again, an opportunity to look at that. And with that said, what I'll do is I'll turn it over now to Daniel Olson to go ahead and speak towards the overview today. Daniel?
Great. Thanks very much, Findley. So before we get started, just given that this is a technology, life sciences, and communication industry-focused presentation, the bulk of what we will be discussing today will be largely focused on the lessee side of transactions. Alex will cover a bit later some of the lessor side. The first area we will discuss today is the overall scope of what is included within ASC 842 leases. ASC 842 governs all leases, including subleases, as defined within the standard. We will discuss later in this presentation the definition of a lease under this new standard, as it does differ from legacy GAAP or ASC 840. A common question I get from my clients on both the public and private ends is, will my facility leases get included in this new standard, or is this strictly related to capital leases? In short, the answer will most likely be yes, that these will be included, but it does depend on the facts and circumstances of a given lease. In a nutshell, ASC 842 introduces new topics for both operating and financing type leases. The most pervasive area includes the impact to an entity's balance sheet, as all leases are now recorded as a right-to-use asset and a related lease liability. There are further implications for the statement of cash flows as far as where the expense is recorded geographically, either under financing or operating activities. We will go into further detail over these impacts and the distinction between how these leases are recorded differently as operating and financing type leases. There are additional disclosure requirements that we will explain in more detail as the nature of these lease arrangements has changed and the manner in which they have been presented in the core set of financial statements. Alex will cover the disclosure impacts later on in this presentation. It should be further demonstrated that ASC 842 does not include the following: intangible assets, biological assets, inventory, or assets under construction. Instead, these items will continue to fall under their historical areas under applicable GAAP. Next, we will go into the effective adoption dates for the standard. Findley touched on this briefly earlier, but just want to reiterate some key points here. Public entities are required to adopt for annual periods ending after December 31st, 2018. Private entities are required to adopt 1 year later, or for annual periods ending after December 31st, 2019. Under the original standard as it was released under ASU 2016-2, this new lease standard required all entities to retrospectively restate previous periods in the adoption of the new standard for the comparative periods presented. We will go over in the following slide an updated alternative to this adoption method that we hope will alleviate some fears or concerns you may have as you go through this adoption process. As we continue to dive into the meat of this new standard, I have some recommendations given the groups that we saw who are attending today. For those public entities listening to this presentation today, I recommend beginning to consider not only the financial and business process impacts that will be relevant to such an accounting policy adoption, but also the control implications associated with this new standard. In most cases, a new accounting policy control will need to be adopted, as well as controls covering the completeness, valuation, existence, and cutoff assertions associated with the recording of the assets, liabilities, and related expenses of these leases. For those private entities listening to this presentation, I encourage all of you to look to your peer companies for how this new standard impacts those companies' financial statements and the related footnote disclosures. Similar to the timeline of the new revenue recognition standard, or ASC 606, public entities are adopting first, giving you, private entities, an added benefit with being able to review how the standard was adopted. As such, I recommend looking to the interim Form 10Q and annual Form 10K for the impact on the core set of financial statements and the related disclosures as it relates to the standard. For those accounting, finance, and consulting professionals listening, I encourage you to consider the impacts to your clients and how this will impact your clients' operations and financial statement reporting processes, especially in the first year of adoption, as there is much to consider in the scoping, recording, and reporting phases of adoption. We will go over these in subsequent slides. As mentioned on the previous slide, during July 2018, the FASB issued ASU 2018-11. This update to ASC 842 allows both public and private entities to adopt the standard under a modified approach, which permits entities to not have to recast comparative periods under adoption. Instead, under this new optional transition method, entities are permitted to record a cumulative catch-up to retained earnings in the current period, with further disclosures over the impact on previous periods on day one of adoption for those related assets and liabilities in question. This revised adoption method came about as a result of numerous entities expressing concern to the FASB over concern over the administrative burden associated with a full restatement adoption approach. Given the simplification that ASU 2018-11 provides, we expect the majority of entities to adopt under this approach. Now we will cover some key areas that we have determined to be key focal points entities should consider when adopting the provisions of ASC 842. Entities need to consider all leases and should consider all facility, equipment, and other arrangements that qualify under this new standard. The scope and breadth of this accounting standard change will vary from entity to entity, and as such will require an in-depth evaluation process to determine that all leases have been captured, grouped, and recorded appropriately. As an aside, I know that all businesses and entities have been very much focused on ASC 606 and the adoption and implications for revenue recognition. This standard is extremely pervasive throughout a variety of entities, and as such will require much time and effort in that regard. Entities will need to consider on a contract-by-contract basis the terms that are relevant to that arrangement, including but not limited to the lease term, potential purchase options, variable lease payments, discounts or incremental borrowing rates, and a lease's initial direct costs. These areas are important to consider as they will direct the way in which an entity evaluates and ultimately records the right of use asset and related liability on the balance sheet. In areas where leases have entirely similar fact patterns, should there be more than one, it may be beneficial to assess these leases as a portfolio and record them in a group fashion. Entities will need to exercise caution when applying this approach and ensure that all facts and circumstances result in materially similar assumptions for such a group of leases. The key point here is that there is much to consider under this new standard, and it is important to start discussing this with your finance teams and auditors as soon as possible. I will now transition this slide to Findley for further insight on implementation topics.
Thank you so much, Daniel. One of the things that I'm having a lot of conversations about our clients with is what does this really look like, right? So here's some key focus areas, and Daniel brought up a couple of things that aren't mentioned, or some of the concept of embedded leases and a whole host of other things that also fall into this. And really from our perspective in helping companies initially adopt this, is we really see this as a three-phase approach. The first one is really the planning, and you can see there even the first bullet point of identifying all the leases. It sounds really straightforward, but what we've seen in practice as we work with companies is they don't know what all their leases are. So again, what we do is we treat this as a three-phase project. The first one is looking at the planning, which is to assess the leases, identify all of them, create a population of those leases, and create a roadmap for what you're really going to do as part of this evaluation process and initial adoption. So that's the first phase, is planning. The second one is doing an assessment and understanding what the financial statement impact could be. And so as part of this is not just identifying the contracts, but really evaluating them and then looking to see what the impact would be on the financial statements. And as part of that, that's also got ancillary impact to the organization. So it might mean that you need to go renegotiate debt covenants and some of these other things. And a number of the lenders realize this is coming, and it's going to change the look of your balance sheet and what that leverage structure looks like. But again, that's one of those things as part of that assessment phase and kind of assessment and financial statement impact. And then really after that, it's implementing the standard and actually implementing that and putting that in your financial statements. So again, if you're a public company, as Daniel just shared, that's going to go live January 1 of 2019 if you are a year-end calendar company. And so secondly is if you're a private company, you obviously get a year in addition to that. But as part of this also is as you go through this three-phase approach, the first one in planning, second one that assessment and financial impact evaluation, and then the third one is the post-implementation. And so if you're a public company and you've gone through it, you've put this in your Q1 financial statements, so Q1 of 19, you've done all that. It's also then building out policies, it's evaluating what the controls are, having that impact on your SOX documentation, and having really a method and a plan for the ongoing maintenance of this whole leasing standard and developing that really into your financial statement standards, or in your financial statement preparation, as well as just the accounting operations process of how does a contract get through in terms of a lease contract. So again, there's a lot of things to consider, but really from our perspective, it's starting with planning. And so if you're a private company, we encourage you to do that planning right now just to see what's coming down the pike. If you're a public company, we encourage you to already have done the planning and then get into that assessment and really be in the heart of it right now, including getting your arms around all those contracts and then having those discussions with your auditors. To the extent that you can, certainly we can, you can accelerate some of these things. You might be able to defer a little bit. If you're a public company, I know that represents about a third of you today. We'd hope that you're in that second phase, or if not, maybe that second phase, even in that third phase of you've already calculated what this is going to be and you're going through that process of updating the policies. So with that said, let's get a little bit into our next polling question and give everybody an opportunity to say where they are in implementing ASC 842. So again, as I mentioned, go ahead and pick the answer that best represents where you are. I'd hope that everybody's at D, we are done, but I know that's not true. I know we're working with a lot of companies right now as they're going through that. So again, pick the answer that best represents your company or organization you work with in terms of where you are in implementing 842. And again, I'm going to give everybody just a few minutes here to answer that. As a reminder, you do need to answer 3 of the 4 polling questions to get CPE credit today. And again, that is limited to people who are listening to this live versus those who are listening to later recorded. So again, if you're live, please go ahead and click the answer. All right, go ahead and close in this. Hopefully you got your answers in. All right, so it looks like, and everybody can see on the screen here, but we've got some organizations that are pretty close. That 3%er that you are done, congratulations. I wish you the best there. Nice work. You can help the rest of us out. But I think really it looks like the majority of people are in the first A or B. That first one of 43% is you're beginning to think about that. And I think that corresponds nicely with the private companies that we have on the line today. So realizing that about half of you are private companies that are on the call today, and about half of you are starting to think about it. We got 35% they are starting to plan and analyze, which is good, and I imagine that includes some of the private companies as well as in the process of that. The third one is we're in the middle of the analysis, some 18%. I hope that that's primarily our public companies that are represented on today's webinar, and you can close that out here pretty soon. So again, I think this is coming along nicely. I would encourage you again to be thinking about those kind of three phases as I laid out on the prior slide of really that planning is phase one, the assessment and the impact is phase two, and then phase three is kind of that post-implementation. A lot of times people think about post-implementation as it relates purely to an IT implementation, but again, this is post-implementation really refers to how do you have these policies or procedures in place, how do you kind of systematize and put this into a maintenance mode so that you can report on this accurately and timely and make sure that you're gathering all those contracts. So again, something to encourage you to do here. So again, what I'll do is I'll turn it back over to Daniel here, and we'll dive into the next piece in terms of just understanding the standard a little bit more. As I said, is we're going to dive now deeper into this, and then we'll also include a couple examples. Daniel?
Thanks, Findley. As mentioned earlier in this webcast, we are now going to define what a lease is under ASC 842. A lease is a contract or part of a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Some key areas include the concept of the identified asset and that of customer control, which we will explain in further detail, as there may be scope exceptions that may cause an arrangement to fall outside of the scope of ASC 842. For now, we will focus on this definition and further describe what makes up a lease under this new standard. Let's start with the concept of an identified asset. Under ASC 842, this definition requires these to be explicitly or implicitly identified within an arrangement with no ability to substitute that asset. Under this concept, it would not be considered a lease if there is a substantive right to substitute should both of the following exist. If there's a practical ability to substitute the identified asset, and there would be a benefit from exercising that right. In these particular instances, this would be a scope exception that would push this particular agreement outside of the scope of ASC 842, as there is no identified asset. Next, we will discuss the concept of the right to control, which represents a bit of a shift in the definition when compared with legacy GAAP. Under the new standard, the right to control requires a lessee to be able to direct decision-making over how and for what use the leased asset is used during the lease term. The definition of a lease is similar under the new standard to that of the old, but the new standard does use the concept of control similar to Topic 606 and Topic 810, which include both power and benefit concepts, which isn't in current Topic 840 or legacy GAAP. One subtle but important difference is controlling the use of the asset, which is the new standard, versus controlling the physical access to the asset, which is the old or legacy standard. Under legacy GAAP, it was determined to be a lease if there was a right to either operate or control access to, or to take substantially all output from a given asset. Under new GAAP, it is a lease if there is a right to control the identified asset. As such, the scope has been broadened in this regard. By now, you may be wondering, what is the benefit of this new standard? The FASB has developed a standard for further financial statement transparency with respect to an entity's lease obligations, which historically were buried in lease commitment schedules in the notes to the financial statements. Furthermore, the standard demonstrates both the economic benefit from a right to use a given identified asset along with the present value of the future liability associated with these arrangements on the balance sheet, effectively just recording these and demonstrating to the users the impact that it would have from both an asset and liability side. This represents a similar shift to what we've seen with the changes in the new Revenue Recognition Standard, or ASC 606, as it provides more uniformity in the application for all entities. This standard also creates a more robust reporting framework, providing the users of the financial statements with insights to the details of leases and any assumptions used in recording them. This next slide demonstrates the concepts related to finance and operating type leases as defined under ASC 842. As referenced earlier in this presentation, there still are two major types of leases, operating and financing type leases, as demonstrated on the left. There still are overarching similarities between these two and how they're recorded. Let's start with the balance sheet portion on the left side of the table on this slide. All leases will require future lease payments to be accumulated and then brought to their net present value. That balance represents the lease liability. The lease asset includes the aforementioned lease liability as well as any initial upfront costs or prepayments of rent. We will go through some examples later in this presentation and further reinforce these concepts as we work through this material in subsequent slides. While not specifically discussed in ASC 842, lessees are generally required to present all right-of-use assets as long-term assets. This is consistent with how other wasting assets, such as intangible assets and property and equipment, are presented on a classified balance sheet under the guidance in ASC subtopic 210-10. Lease liabilities should be apportioned into current and non-current components. This presentation requirement could result in lower liquidity measures, including the current ratio. As such, companies with certain covenants in debt or other agreements should evaluate the impact these presentation requirements will have on their compliance with those covenants. The basis for conclusions to the new lease accounting standard discusses the intention to intentionally characterize operating lease liabilities as operating liabilities rather than debt or debt-like liabilities. This is because from an economic perspective, they are significantly different from finance lease liabilities. This economic dissimilarity is a factor considered by the FASB for prohibiting operating lease and finance lease liabilities from commingling and from viewing operating lease right-of-use assets as economically dissimilar from finance lease right-of-use assets. Effectively, the FASB just wants things parsed out separately. So we'll see different groups on the balance sheet, as Alex will discuss later in this presentation. While operating lease liabilities aren't technically considered debt under U.S. GAAP, some creditors may view them that way. Accordingly, entities need to carefully review the provisions of existing agreements, including debt covenants, to ensure that recognizing operating lease liabilities following the adoption of ASC Topic 842 won't cause the failure of debt covenants or have other unanticipated consequences. For all entities listening today, I recommend getting in front of these changes early and ensuring that your ratios and related covenants are communicated and discussed with your financial institutions and auditors. With respect to the income statement, finance type leases amortize the right-of-use asset over the useful life with the related interest expense. Interest expense under finance type leases is considered to be more front-loaded at the earlier stage of the lease, given the timing of the remaining payments. Operating leases, on the other hand, are a little more straightforward in that there is a single straight-line expense. Now we will discuss the impact of the statement of cash flows, which can be seen on the right side of this slide. With respect to the statement of cash flows, cash payments for the principal portion of lease liabilities arising from financing type leases are shown as cash outflows from financing activities. Lessees should present all other lease-related cash payments or receipts from subleases within the cash flows from operating activities, regardless of whether they're associated with financing or operating leases. Cash flows associated with bringing an asset to the condition and location necessary for its intended use should continue to be classified as an investing activity. It should be further noted that there are specific considerations for short-term leases, or those leases which are 12 months or less. Under ASC 842, such leases contain a scope exception, which allow entities to exclude them from recording them on the balance sheet. This is vaguely similar to that of the contract assets that we see under ASC 606 as a practical expedient. All entities should carefully evaluate whether a lease has a maximum term of 12 months or less, as a month-to-month lease may not qualify as a short-term lease if the lessee is economically compelled to renew the lease beyond 12 months. This could occur for a few examples, and as a couple examples, the leased asset could be of a specialized nature and difficult to replace, or the leased asset is necessary to fulfill customer orders under long-term contract, so it could be commercially disruptive to exit that lease. We will now go into further detail on this slide on how to determine if a lease is a financing lease under ASC 842. The concepts on the left side of this slide are general comments as entities assess the 5 criteria on the right side. These 5 criteria will be our focal point for today. The first 4 conditions of lease classification are fairly similar to legacy GAAP, except that there are no longer any bright line or specific numerical values that automatically trigger finance lease classification, as has been the case under legacy GAAP. While you can't simply default to legacy GAAP ASC Topic 840 bright lines in evaluating the 3rd and 4th criteria listed here, the new leasing guidance does state that one reasonable approach to assessing these criteria is to conclude that a financing lease results if either the lease term is equal to 75% or more of the remaining economic life of the leased asset, the present value of lease payments plus any resale value guarantee, or RVG, as you see abbreviated here, equals or exceeds 90% of the fair value of the leased asset. If the classification of a particular lease is unclear, lessees should return to the underlying distinction or spirit of ASC Topic 842, which effectively classifies whether a lease should be an installment purchase in which a lessee essentially acquires substantially all of the economic benefits of an asset and pays for this acquisition over time. If so, this arrangement should be classified as a finance lease, even if the lease term is for less than 75% of the asset's remaining economic life, or the present value of the lease payments is for less than 90% of the leased asset's fair value. In this regard, all teams should be working with their finance teams as well as auditors to ensure that they understand the facts and circumstances of each arrangement, as a financing lease could potentially be expanded as compared with legacy GAAP. As a general comment, within the 4th box down on the right side, the residual value guarantee is undiscounted in this case. However, when calculating the lease liability, it would be discounted. And that means at the net present value. As mentioned on the previous slides, both operating and financing type leases record a right of use asset and lease liabilities. The right of use asset is a sum of the lease liability as well as any initial upfront costs or prepayments of rent, with the lease liability being the net present value of all future lease payments. Financing leases create a front loading of expenses versus straight line method, which is for that of operating leases, given the embedded interest expense, which is recorded in conjunction with the remaining future lease liabilities. It is also important to note that the commencement date has been defined as the date in which the lessor makes an asset available for use by a lessee. Now let's walk through an example. John Snow enters into a 10-year lease with an option to extend for 5 years. The lease payments are $50,000 annually, paid in advance for the first 10-year period, and increased to $55,000 if extended. The option to renew is not likely. The incremental borrowing rate is 5.87%, and there are initial direct costs of $15,000 incurred. One of the key areas that I want to emphasize here before we move on to a few calculations and details that we'll go over is that the first payment would be $50,000 upfront. The first item we will calculate in this example is the lease liability on day one of the lease arrangement. As you may recall, lease liabilities represent the net present value of the future cash flows associated with the lease arrangement. In this case, that represents 9 years of payments at $50,000, discounted at the stated rate of 5.87%, or approximately a $342,000 liability. Again, this liability will continue to be reduced in the future by those remaining 9 $50,000 payments over the lease term. The right-of-use asset is a combination of the lease liability, so the approximate $342,000, direct costs of $15,000, and initial prepayment of rent of $50,000. The next piece we will calculate is the amortization expense, which is the total right-to-use asset divided by the lease term, or approximately $41,000 a year. You're using the 10-year term in this regard because that is the total term of the lease, and that would be amortized over that 10-year period. The initial interest expense recorded is taken by using the lease liability and multiplying that by the stated rate. As mentioned earlier, this will continue to drop as the lease is paid out over the term. And now I will move to Findley for another polling question.
Wonderful. So I think this is our third polling question. As a reminder, you need to answer 3 of the 4 in order to get CPE credit. So again, do you expect your organization to change its strategy for leasing and buying as a result of the changes? So go ahead and pick the answer that best represents your organization. I know we've gone through this and we've had a couple examples, certainly, and we'll have an opportunity to do a little bit more here in terms of getting into what some of the impact is, both day one and then kind of that ongoing piece. But again, wanted to give everybody an opportunity to answer this and get CPE credit. Give everybody just a second longer. All right, here we go. So it looks like the overwhelming majority, some 61% of you said that you don't expect to actually change this. So, you know, as part of this, it was very interesting to me is I think that this is one of those standards that's going to have a very significant change to the way the balance sheet looks like for most organizations. Certainly given that most of the organizations I work with in this space, in that technology, life sciences, communication space, don't have a lot of capital leases, so I think this is going to have a lot of change to that. At the same time, it looks like you guys don't expect to have much change in terms of how you actually go about leasing or buying equipment, space, et cetera, as a result of that. So I'm imagining that a lot of this is going to come into disclosure. We are going to have an opportunity to talk a little bit more about disclosure on the coming pages. But before we do that, let's jump in and look see what day one looks like. So again, turn this over to you guys and let you guys tackle this. Go ahead.
Thanks, Findley. The key portion that we'll talk about in this slide are non-lease components. Non-lease components include goods and services that are provided to the lessee, which are separate from the right-to-use leased asset. As a general concept, ASC 842 requires lessees and lessors to assess the direct component which is associated with that leased asset. Examples of non-lease components could be 2 years of scheduled maintenance on a leased automobile or security or janitorial services for a leased property. When these services are included in the lease, however, these should be further allocated to the total consideration of a given arrangement and parsed out. Said differently, these items would not be included within the right-to-use asset or liability. Now we will transition to Alex with further details over the impact to the financial statements.
Thanks, Daniel. So obviously with the introduction of the new lease standard, there will be some financial statement presentation implications. That being said, our goal here is to highlight some of the key implications that will affect the presentation from both a lessee and a lessor perspective. In regards to the financial statement presentation for the balance sheet from a lessee perspective, under topic 842, the lease identification test is going to be the new test to determine whether an arrangement is treated as an on or off balance sheet item. Whereas under legacy GAAP, the critical determination in the lessee accounting was the lease classification test. So more specifically, lease assets and lease liabilities were recognized on the balance sheet only if the lease was classified as a capital lease. In contrast, under topic 842, a lessee recognizes lease assets and lease liabilities for all leases, regardless of whether they're classified as operating or finance leases. This is just with the exception of the short-term leases, as Daniel mentioned. So that being said, once a lessee has identified a lease, they will present both finance lease and operating lease right-of-use assets separately from each other and from other assets presented. Additionally, the same concept will be applied to both finance lease and operating lease liabilities, in that they will be presented separately from each other and from the other liabilities presented. If a lessee does not present its finance and operating lease right-of-use assets and lease liabilities separately on the balance sheet, then they must actually disclose line items in which the assets and lease liabilities are included. And similar to any other non-financial assets and financial liability, right-of-use assets and lease liabilities are classified as either current or non-current on the classified balance sheet. So one of the things I wanted to highlight in regards to the presentation is the requirement that finance leases and operating leases cannot be included in the same balance sheet line item is primarily a function of the board's view that finance leases and operating leases are two different types of transactions, whereas one being more similar to a purchase of the underlying asset, which is the finance lease, and the other being simply a rental of another entity's owned asset, which is the operating lease. So in the board's view, presenting the assets and liabilities that result from these two different types of transactions in the same line item would be misleading. So that's kind of the logic behind separating the two. In regards to the financial statement presentation for the balance sheet from a lessor perspective, a lessor will present the net investment separately from other assets for both sales type and direct financing type leases. Additionally, the net investment is subject to the same current versus non-current classification considerations as other assets on the classified balance sheet. So moving on to the impact on the income statement. In regards to the financial statement presentation on the income statement from the lessee perspective, for a finance lease, a lessee will present the interest expense on the lease liability and the amortization of the right-of-use asset in a manner consistent with how they present other interest expense and depreciation amortization of similar assets. Furthermore, these are not required to be presented as separate line items. For operating leases, a lessee will present lease expense in income from continuing operations. Moving on to the lessor, in regards to the financial statement presentation from the lessor perspective on the income statement, for all leases, and this is applicable to all leases, lease income should be presented separately in the income statement or disclosed. For sales type and direct financing type leases, a lessor should present the selling profit or loss recognized at the lease commencement in a manner that best reflects the lessor's business model. So moving on to the statement of cash flows, in regards to the presentation from a lessee perspective, for finance leases, a lessee will classify the repayments of the principal portion of the lease liability as a financing activity. The variable lease payments and short-term lease payments that are not included in the lease liability are actually treated as operating activities. For operating leases, a lessee will classify lease payments as operating activities, and the variable, similar to the finance leases, variable lease payments and short-term lease payments that are not included in the lease liability are treated as operating activities. Furthermore, the initial recognition of a lease liability and a right-of-use asset for a lessee is considered to be a non-cash transaction that is not included in the statement of cash flows, but this is actually separately disclosed with other non-cash transactions. In regards to the presentation on the statement of cash flows from a lessor perspective, all cash receipts from all leases are going to be classified as operating activities, as I think Daniel mentioned that earlier. So one of the things here to note is that the lessor treatment is different from legacy GAAP, as ASC 840 did not include guidance on the classification of cash received from leases in a lessor statement of cash flow. So this is one of the key differences from legacy US GAAP. So just something to highlight in regard to that. Moving on to financial statement disclosures, footnotes. So Topic 842 requires more qualitative and quantitative information about their leases than legacy GAAP. This is definitely going to be an area where companies are going to need to evaluate their systems and current data collection processes in order to determine whether they're conforming with the disclosure requirements. So examples of new qualitative disclosures from a lessee perspective, basically the two key areas are going to be requiring more significant judgments and assumptions and more information about the nature of the leases. So in regards to the significant judgments and assumptions, examples of this include determining whether a contract contains a lease, determining the standalone prices for the lease and non-lease components, which is probably going to be a tricky area, and determining the discount rate for an entity's leases. In regards to, additionally, the new qualitative disclosures will require the information about the nature of the leases. So examples of this will be terms and conditions of variable lease payments, the terms and conditions for extension and termination options, purchase options, and residual value guarantees. So once again, to highlight, it's more extensive, elaborative disclosures are to be required under 842, whereas 840, it was pretty limited in that sense. So moving on to the disclosure impact from a lessor perspective, same concept, more qualitative and quantitative information than previous legacy GAAP. Examples of new quantitative disclosures are going to be facts and figures about respective arrangements. And so this will be operating lease costs, amortization of finance lease, right-of-use assets, variable lease costs, weighted average remaining lease term. So those are some examples. And regards to the qualitative impact, same concept, determining whether a contract contains a lease. And maturity, so also in regards to the quantitative impact, just to touch on this as well, the maturity analysis of lease receivables for sales type and direct financing leases is also going to be an example of an extensive quantitative disclosure that will be required. So in regards to kind of at a high level, as I mentioned, the key difference between legacy GAAP and 842 is that the lessees and lessors were subject to relatively limited disclosure requirements. The board's decision to expand the lessor disclosure requirements was intended to basically provide financial statement users with more information on how risks to which a lessor is exposed. So, for example, collectability of lease receivables, so the credit risk exposure associated with that. Additionally, they wanted to provide additional information about a lessor's lease income. So that being said, I'll transition over this to Findley for our final polling question.
Yeah, thank you, Alex, and thanks for taking us through some of the disclosure impacts in terms of what this looks like. Our last polling question, and again, you need to answer 3 of the 4 to get CPE credit. You also need to attend for at least 50 minutes. I didn't mention that previously, but I want to make sure that you guys are clear on that. So the last question is, what do you foresee as being the biggest challenging in preparing to implement 842? Go ahead and select the answer that best represents what you're doing or kind of where your organization's at. I'll give everybody just a couple seconds here, and then we'll continue. All right, looks like everybody's had a chance to go ahead and do that, and so we'll go ahead and see what the results are. Looks like kind of decreasing order here. That's great. So 1 is understanding the accounting disclosure requirements. I think that is really the challenge, and hopefully you heard a lot today to help you understand a little bit better what this looks like. I know we've got an audience that has a variety of experience in terms of dealing with 842, and in fact even reading the standard, reading articles, et cetera. So that's the first one. Second one is collection and abstraction of lease data. I think from my perspective, one of the things is I'm helping companies implement the standard is really getting their arms around all of the leases. I think certainly as a lessor, that's easier. As a lessee, I think that could be challenging. Certainly we've got things, office space and equipment rentals and some of those things. But then also, I was talking with a CFO this morning, and he mentioned using a contract manufacturer, and we started going down the path of embedded lease and what that looked like. So again, I think there's some natural challenges in implementing this standard, certainly, and I think part of that is just understanding, identifying where your leases are. So again, I encourage you guys to think back towards that 3-phase approach we set up front of really planning this out, doing the assessment, and evaluating what the impact of financial statements is, and then kind of that post-implementation practice. Thank you so much for being part of today's presentation. Just in conclusion here, I think one of the things that's really important as we think about this is that the more leases that you have in your portfolio, and again, you do have the opportunity to take a portfolio approach, like Daniel mentioned earlier, the harder it is to do this, and certainly the more time it's going to take. I think regardless of the size of the organization you represent, there is a lot of work to do around 842, even if you think it's a slam dunk. We've got, 1 building space and a couple copier leases and maybe a phone system. Again, it's going to take some time to get around that. Certainly in my example of dealing with a contract manufacturing organization, it could be that that also needs to be evaluated and run through the framework under 842. So again, as I'd encourage you to take that time to seek out the resources both internally or using third-party providers, ourselves or someone else to help evaluate that. And then also collaborating with your external auditors, with management, working with the banks, working with others, the readers of your financial statements if you're a private company, and really helping to understand and shed some light into what this is going to look like. I think that's one of those things that I'd encourage all organizations to do as they go through this. But ultimately, I'm confident if you put together the right team, break this into pieces, kind of those phases I mentioned before, and really build out an ongoing maintenance plan to how to maintain this, that you'll have a successful transition into 842. And again, I want to thank you for attending today's webinar. I'd encourage you to stick on for just a few more minutes here. A couple things as we get into this is we will be taking some questions now. We've got a couple questions that came up during the course of the presentation that I wanted to just highlight for our group. And then a couple things that I think we also heard, and this is, as people went through this, whether you submitted them at the bottom, and there is an opportunity to ask a question right now in the Q&A function at the bottom, or whether some questions that came in a little bit earlier. I think there are a couple questions. One I want to start with, somebody said, as you enter into new leases, can you adopt those on those new leases? This isn't something we can opt in and out of lease by lease. You either have to take them all or take them one by one. So that's one question I saw, and I think that's probably a question that maybe other people have as well. See another one, and Daniel, maybe I'll ask this one for you. And the question was, what options to extend leases be considered at the beginning of a lease term? How do you factor those in to determination of the new assets and liabilities that get recorded? You need to you have a history of extending the lease and taking advantage of those. What should you do? So again, Danny, do you maybe want to answer that question for me?
Yep, absolutely. Thanks, Findley. In those instances, it really depends on the facts and circumstances. And Historical benefits are always good to take a look at as far as what you as an organization have done. But as an organization, if you have a right to renew or extend a lease, at day one, you should consider that in conjunction with the initial reporting of the right to use asset and lease liability, and consider what the future payments look like under that. So effectively what you would be doing is you would be adding that to that net present value feature if it was more likely than not that you would actually be taking advantage of that lease extension.
Perfect. Well, thank you, Daniel. Looking at we had another question that came in and said, hey, how do you a lot of the literature, the guides that have been published speak towards, what do you do when you enter into a new lease but don't cover kind of the existing lease, right, which is the case for nearly all companies. I would encourage you to just look. There's actually where you can download the slides as part of this presentation. There's also a link to our lease guide that's got some good information in there. Includes information on how to account not just for all new leases, but then also how do you handle some of those existing leases. So again, and that's a pretty good guide. Spent some time putting that together. I encourage you to look at that. And it is, again, available through your browser right here. It's a 36-page or 37-page guide on what this looks like, and certainly it's got more information than we can present just during a 50-minute webinar this morning. So, again, I'd encourage you to look at that. I've got another question here. It's related to disclosure. So, Alex, I'll pose that to you. It says, what are the major changes in the disclosure requirements, and how do they differ from the current requirements related to the future lease commitment schedule? So, Alex, you want to tackle that in terms of just the disclosure and what that looks like in terms of future minimum lease commitments?
Yeah, that's a great question, Findley. Kind of how we touched in the presentation. The biggest key difference from a high level is just the amount of disclosure requirements under 842. So there's more extensive requirements with the new standard. Now, obviously, with 840, there wasn't, from a lessee and lessor perspective, there was limited disclosure requirements. So that's kind of the biggest key difference, just going through and actually identifying what information needs to be put for those disclosures. In regards to the future lease commitments, the biggest difference here is just elaborating on the assumptions and the nature of the agreements, whereas under 840 you just had the requirement just to present the future minimum lease payment. So I think at a high level, it's just going to be more extensive and more elaboration information that will allow the financial statement users to kind of get a good understanding of those lease commitments.
Great, thanks, Alex. Looking through a couple other lease questions we've got here. One person saying they don't see the 36-page lease guide. Yeah, so if you go ahead and look, and you can download, you actually download the copy of today's slides, and also got some references to the alert that we just put out for tech, communication, and life sciences companies, as well as this guide. If you don't see that, I can shoot you a list. In fact, one of our presenters will answer that to you right now. So again, you can go ahead and do that. And there's also going to be a link at the end of this presentation that also links you to a survey. Then another question that we had is there a software package out there that helps keep track of leases? That's a great question. That's a question from Brent. Brent, thanks for asking. We have a lot of clients right now that are going through that process of saying, boy, we've done this initial piece, we're putting it all in the spreadsheets. How do we track that on an ongoing basis, or how do you enter into new leases? I think the key piece there is there are some software packages that are helping with that. We're going through the process of evaluating a number of those right now as we go to help our clients. And as part of that, I think there is going to be some kind of maturity in that lease accounting packages, kind of that software space. But really what I'd say right now is a pretty immature market. The important thing in terms of getting over this initial hurdle is identifying all your leases, getting the terms in there, is basically doing abstracts, and then from there evaluating the leases under the standard, under 842 versus 840. And so as part of that, I think that was going to be a key piece. There's also I would encourage you to look at some of those lease packages or software lease packages. We haven't done all of that. We haven't evaluated all of these yet. Seems like there's a new one popping up every minute. But again, I think some of the more simple models would be great in terms of just using Excel and identifying that. There are some other programs that will actually help kind of build this out. As far as we've seen, I haven't seen any that's been kind of the silver bullet of actually calculating everything for you. So again, realize that that's a change. I do see a couple of people said that they weren't able to download the lease accounting guide, but what we can do is we'll include a link to that lease accounting guide in the follow-up email as a result after we send out this presentation and complete that. So again, I do want to just thank everybody for the opportunity to share a little bit about what 842 looks like. I do know that there are a number of questions coming in, but we're right at the top of the hour, and so we're going to go ahead and let everybody drop off. I do want to thank our speakers today. I want to thank you as participants for joining. And on behalf of the speakers, on behalf of the firm, thank you for participating with us today. We will go ahead and try and answer as many questions as we can now just through the system there. So if you have any further questions, feel free to do that. You can also reach out to any three of us. You can see us here on this speaker bio with both our email and our phone number. We'd appreciate any questions you have and be willing to help you out in that. And then lastly, from there, we'll have a word quickly from Emily as we close this out. Again, thank you all for attending. Emily?
All right. Thank you, Findley, and thank you to Daniel and Alex for a great presentation today. We certainly had a lot of material to cover. If you still have questions, you can submit them in the Q&A window or reach out directly to our speakers, and we'll be happy to follow up with you. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.